Welcome, everyone. We appreciate everybody joining. If you're a former attendee, we reviewed the CU scorecard last quarter around November timeframe, and we'll do a quick recap of that, and we'll get into that. But really, we're going to spend the time today going through the trends that we've seen over the course of 2025 and what that means for the credit union space, and also analyze some of the things that we're seeing and what that means for 2026 as we start to look ahead to the remainder of the year. I'm joined by Molly Petersen, who is going to walk through a little demonstration of how we've driven some results and outcomes for some of our credit union customers. But I guess at the end of the webinar, here's some of the things that we're going to review and what we hope that you'll walk away with a clear understanding of what Q4 and the full year of 2025 in the credit union world look like, what the data has told us in relation to not just your credit union and how you can look at your performance, but then how you've performed against your peers, credit unions that are kind of in your same tier, and then also credit unions within your state or your geographic footprint. We'll talk a little bit around insights into why certain growth trends within the industry that we've seen that look positive on the surface for credit unions in 2025 may actually be challenging to sustain in 2026 and beyond. Just take a look at the framework and evaluate each of your institution's risk and opportunity based on what the CU scorecard data is telling you. We'll give each of you access to the CU scorecard. We'll do a quick high-level review of what you can find in there, and then we'll walk through the analysis of what that looks like. And then, as mentioned at the top, Molly's then going to walk through some practical ideas for how you go and acquire not just any new member, but the right new members, and retain the right members and drive more lifetime value across your member base. And Molly has actually sat in your seat. She came from a credit union, has now been with BlastPoint for a few years. So we're excited to have her as part of the webinar today. So to get started, you can access the CU scorecard by just scanning the QR code right there on the left. That'll also give you the packet with the white paper on the credit union benchmark report, as well as a case study that we did with Whitefish Credit Union around member acquisition in an underpenetrated market, the Missoula market for them, and a bunch more resources. So I'll give it 30 seconds here for anybody that wants to scan the QR code. That will get you access to the CU scorecard. We will actually send this out to everybody after the webinar as well. So continuing on, maybe a quick 2-minute blurb around BlastPoint, who we are, some of the folks that we work with, what makes BlastPoint unique, and why it actually matters in the world of financial services and credit unions as a whole. We're actually a member intelligence platform. We were born out of the AI and machine learning lab at Carnegie Mellon, and we really got our start working with a lot of utilities across the country. And so when you look at the map here, we have data for 25% of US households and businesses, and why that matters in relation to financial services and specifically credit unions is it allows us to actually take that rich top of the income ladder or top of the economic ladder information and start to build models and machine learning scenarios around what the data is telling us. And what we do is we then take that and we marry that information with your first party data. And then we also leverage third party sources, think Experian, TransUnion, Axiom, some of those, and then open source information that is publicly available for any of you to get, but very dense and hard to sift through. And we take all of that information and we marry it together to provide rich insights that allow you to start to predict behavior of your members and also prospective members on what they might be most interested in, what types of products, what channels you should engage them with, what areas or zip codes are the people that have the highest propensity to actually become members or to adopt a certain product. And so the secret sauce with BlastPoint is really taking all of that information, marrying it together, and as a result, a lot of the credit unions that you see on the bottom there, we've been able to help them drive about 4% improvement in member acquisition, about a 4.6% lift in next best product. And we've helped drive indirect to direct conversion at a clip of about 11.4%. And I know Molly will get into a couple of those use cases when we walk through the platform, but that's just a little background on BlastPoint. Circle is an investor in BlastPoint, which is really a number of credit unions that invest in technologies to help advance what credit unions are doing and drive the growth within the industry. So, to get into kind of the CU scorecard, I'm going to walk through just high level what the CU scorecard is. So, here's the homepage for the CU scorecard. Any of you can just come in, type your credit union name into here, and it will give you all of the financials around how you're performing. But then what's unique about the BlastPoint CU scorecard is we've then taken it and we've broken it down and done a peer analysis around how you're performing against your various peers, how you're performing against the others in your state. And so if we take a look and we click on a full analysis here, you can start to see what's happening nationally, get a rich analysis there, and then you can start to see the breakdown of the credit unions and where they're categorized. And so when you put your credit union name in there to start to see where you fit, depending on where you are with assets, you will fall into one of these six categories. And you can see the criteria. So small is sub 100 million in assets, mid small community, mid market, large, Titans. Titans are the largest credit unions. And you can start to see, and I'll get into a little bit of the trends around what we're seeing across each of these different tiers. And then you can start to see what's happening across any particular financial metric. And you can slice and dice it by the tier that you're in, or nationally, or by the state that your credit unions support, and start to see how are you performing against the various metrics that are most important to keep moving the credit union forward. So now going back to the analysis, I guess when we start to take a look at the good, if you looked on the surface of 2025, it would look like it was a record banner year for credit unions. ROA is up, net interest margin is some of the highest it's been, asset growth is up. And I think on paper, you'd look and say, okay, we're trending in the right direction. I think that the challenge lies slightly underneath the surface of what happened. And so, what the data, though, tells us is that for the first time on record, credit unions have seen negative year over year member growth. And that's a real challenge. And I think what we're seeing there is you see on the bottom, 83% of credit unions are losing members. The reason a lot of this is masked is because the Titans that we showed, they actually are growing at a much faster clip, but not necessarily organically. And then if you look over here, there's actually acceleration in negative member growth because it was 0.69% over the course of the entire 2025 year. But in Q4 alone, it was 0.39, which if you extrapolate that out over the course of a year is 1.56%. And so it continues to trend in a negative path. And so one of the things that I just referenced was the aggregate growth across all of the credit union tiers is 1.62%. But a majority of that growth falls within that Titans category, the credit unions that are over 10 billion in assets. Credit unions below that are seeing a sliding scale of member growth, and the smaller ones are seeing the most exaggerated member attrition. And so, taking it a step further, here's the details. So you can see the roll up of this, there's a spread of 4.8% between the Titans and the smallest credit unions. So what that's telling you is a majority of the new member growth is happening in the largest credit unions. And it's not necessarily happening organically, it's happening through acquisition and consolidation. And so that's not necessarily a very positive signal for the industry as a whole. What you're seeing though too is the net interest margin actually for the smaller credit unions is better than the larger, but those members aren't as sticky. They're not staying. So I think the big question becomes if you're a $5 billion credit union and you're growing at 2.7%, the question is, are you adding the right members? Are you getting younger with your member base? And I think the reality is a lot of the growth is happening with the older demographic, and it's not happening through organic acquisition. It's happening through consolidation. It's happening through mergers, branch closures, and geographic shifts. And so you're seeing that the larger credit unions are gaining market share, but they're still losing with the younger demographic. And over time, that is not a positive recipe for success. And so what you're looking at here is the younger demographic. These are the people that are taking your market share. The members that you're trying to get, they're going and banking with Chime and SoFi and a number of others like that. You're seeing the indirect auto loan segment is some of the lowest it's been. And then again, the demographic cliff, the boomers that are a majority of your member base, you have to find a way to replace that pipeline with younger members. Sadly, some of those are passing on. And how do you continue to stay relevant for the next generation? So what you're also looking at here is the split between the variable rate loans and how those rates, as rates went up, became a windfall for credit unions, and the CDs have not quite matured yet. And so you're going to start to see CDs that were at higher rates in 2024 and 2025 start to mature in 26. And are you going to be able to keep those members? Are you going to be able to keep those dollars in-house? And so I think the big thing for a lot of organizations is how do you go figure out which ones to engage, when to engage them, and how to engage them to give yourself the best chance to actually retain them as members of your particular credit union and keep those deposits from flowing outside of your particular credit union. It's one of the things that Molly will kind of get into and show you a little around the predictive analytics that BlastPoint has on the back end, tied to a lot of those data points that we talked about at the top of the discussion here, showing how do we go predict who has the highest chance to actually stay with the credit union? How do we go create more loyalty with these members? What should we go talk to them about? Through what channel? And across what geography to engage with them in a way that actually gives you the highest chance to not only keep them, but then go attract additional members and get younger in the process. A couple other things that we're seeing across the industry and really from a macro level, I think when you look at the the left side, and this kind of correlates with what's happening in with your indirect segment as a whole within the industry, is the tariffs have kind of ratcheted up the cost of automobiles. And so loan sizes for a lot of people are getting bigger. And it's becoming harder and harder for consumers to actually be able to pay off those particular car loans. So you're actually seeing consumers extend car loans that used to maybe be 3 years are now 5 years or 7 years or even 9 years we've seen. And so what that does is it adds risk to your portfolio. On top of that, you start to see that consumers, before they even get to the end of that loan period, because of the interest rates and so forth, decide they don't want the car anymore and they're upside down because they actually owe more on the car than the car is actually worth. And so those are some of the things that you're going to see as we start to get to the back half of 2026. On top of that, the Fed has kind of been slow as it relates to just rate cuts, trying to make sure that the tariffs and a lot of the stuff that have been put in place don't actually continue to drive inflation. So they're being very careful and deliberate around what they're doing with rates. So what that means though is you then have these CDs that are coming due, and are you going to renew them and at what rate? Because then if rates come down after you do that, you start to impact your net interest margin that you saw was a positive for 2025. So couple things, the surging ROI in the net interest margin, very positive from a 2025 perspective. But I think what we're diagnosing is that that is a temporary windfall. And then high wallet share and stable credit. What it means is you're deepening the reliance on a shrinking pool of aging members. So the question becomes, how do you not just continue to drive lifetime value for your best members, but how do you go attract newer members? How do you go attract that demographic, taking us down to the last line item there around how do you drive more positive overall member growth, organic member growth, and driving the types of members that you need for long-term sustainability, which is that under 35 relationship. And so one of the ways to go do that is getting out of, hey, how do we analyze this data? It's very manual, very time consuming, and create something that is more automated, very digital, allowing you to quickly analyze what's happening inside your credit union, how you're performing against your peers, how you're performing against others within your state. What do your best members look like? How do we go create more of those? How do we go find more younger members? What is it that we should talk to them about? And in what channels should we engage them with? And the CU scorecard is a way to kind of analyze from a macro level how you're doing against the industry and against your peers. But then it also allows you to start to look and say, okay, where do we need to go drive improvement across these various financial metrics to go ensure that we have long-term sustainability in relation to member growth, lifetime value, and average member relationship. And so when you start to think about that, it's, from the CU scorecard perspective, slicing and dicing by your asset tier at the state level, understanding and filtering out the outliers that exist within those data sets. So the CU scorecard will do that for you. And then really the signature analysis and providing the AI flags that actually start to show you and feed you the information around what you should do next, where you should go, who you should target, and what areas. And so the big question and the big thing from 2025, or the big takeaway, is 2025 was a very good year. What have you done with the gains from 2025? Are you using that to invest in getting younger? Are you using that to invest to have a better digital footprint to go attract a younger demographic, to go attract the younger members, and to create more lifetime value for the existing members that are most profitable for you? And what we're seeing is the ones that are making the investments from the positive gains from 2025 into 2026 are the ones that are actually going to thrive. And there's a lot that are going to, and there's some that might not. And so I think the long-term play is taking a lot of the goodness from what we've seen in 2025 and using that to catapult you into attracting the next phase of member growth. And so I'm going to pause there. I'm going to hand it over to Molly to kind of walk you through these use cases in a live demonstration of how we've driven member acquisition across some of our clients in the credit union world. Molly, you going to
Yeah,
stop sharing?
yeah. Thanks, Dave. Yeah, what we just saw nationally, 83% of credit unions losing members, shrinking primary relationships. That's a really insightful deep dive into the trends in data that inform the strategy that ultimately leads to Blast Point. So, um, I'm excited to kind of provide this deep dive. I always say that Blast Point is a tool that helps you execute on your strategy. So just like this credit union customer of ours, um, I'll walk you through a concrete example here, growing deposits through checking account acquisition. So as you can see here on my screen, this customer has 50,000 members who don't have checking accounts. Now, in the greater scheme of things, 50,000 members is a ton for that overall outreach. If you were to spend a mailer to them, then that would eat up, 40,000 bucks of your budget if I'm being generous and assuming that that's, 8 cents a mailer. You would want to spend, a large portion of that $40,000 probably anywhere else. If you were doing regular email outreach to that 50,000, then that would do some damage to your email open rates. So, as a whole, we want to narrow down this 50,000 and reach the right group of these members who don't have checking accounts and be more precise with our marketing strategy right here. So what I'll do with Blast Point and the real magic here is narrow down this audience. So I can create this segment first of these members who don't have checking accounts. So this is a group right here of members who, this is that same 50,000 who don't have checking accounts. I've just made them into a little group. I can narrow them down and look at them here. But I can now make my marketing more precise by narrowing this down even further. We can call this a checking account campaign. So these are members who don't have checking accounts, and I can personalize the messaging to this group already because I know that they don't have checking accounts. But I can also make my marketing more precise and efficient by using the BlastPoint AI propensity model and use this to target people who are actually more likely to open a checking account right here. So we can say their checking account propensity is greater than or equal to 5. And this narrowed down 50,000 people who just didn't have a checking account to 12,000 people who don't have a checking account and are likely to open one. So if I'm looking to send a mailer, that brings my mailing cost down from 40,000 to about 10,000. So that's another 30,000 bucks that I can spend on digital advertising. I can reallocate it towards creative. I can spend it nearly anywhere else, or we can just save the credit union some money. So that's really meaningful right there. Additionally, BlastPoint unlocks a lot of different channels that allow you to develop further outreach that were previously not possible. So if you want to use some of those more high touch outreach methods that, might not have been possible, we have that possibility too. So let's say you want to use an outbound calling campaign. We can narrow this group down even further and say that we want to reach a group who has a high cell phone channel preference. We can say cell phone greater than or equal to 8. This narrows this group down to 2,800. A group in the call center and across a bunch of branches can knock that list out in no time so that you have this outbound calling campaign taken care of. I can click create segment, and I've got that list pulled in less than 5 minutes. Something that would have taken the process of submitting a ticket, sending it to the IT team, and them pulling it, might have taken a week before just in the turnaround time and friction between teams. Now took me 5 minutes to click download and get it ready to go and distributed. So, as a whole, this is exactly how credit unions can um, stop harvesting on the margin and start rebuilding those primary relationships by focusing on those members who are really likely to adopt those products there. This same workflow can apply to certificates, it can apply to auto loans. It's about putting that right message in front of the right group and increasing that relevancy and precision. So, this is reproducible for any credit union on this call, and I assure you that this is possible for you. It just takes mere minutes in the platform once you send us your data. So that wraps up everything that I had for you, and I'll hand it back to Dave for some Q&A.
Fantastic. Molly, thank you. Uh, I think we have about 8 minutes left. If there's questions from anybody, Anna Marie, maybe you'll be my moderator there.
Yeah, absolutely. If folks have questions in the chat, feel free to drop them in and we can work towards them and work towards answering some of them. I think to kick off, Dave, for folks that are just getting acclimated with the CU scorecard, what's your top recommendation for how they can leverage the tool in their maybe board conversations, leadership conversations, things like that?
Yeah, I would say get in there and start that you again, I was talking a little bit around how you can slice and dice the information. I would get in there and search through your credit union, find your credit union, start to see the tier that you're in, find the areas that you're performing well against your peers in your tier group. I think that the real magic with Blast Point CU scorecard compared to anything else that we've seen out there is the ability to kind of break it down by like credit unions. And so you can start to see where are you performing, overperforming, underperforming, areas of opportunity, broken down really by every financial metric. And so I know there's some organizations that do some of those things, but what we've seen is the peer analysis and breaking it down by how you're performing in the state and your geographic footprint seem to be very meaningful for a lot of executives within the credit unions we work with and their boards. And so I think that's a good way to kind of look at it and just measure yourself against others.
That makes a ton of sense. And then I think this is something that we've heard from folks before. If member growth is below the peer average, what are maybe the two or three highest leverage plays that you think credit unions should consider?
Well, I think as we saw with the analysis, the member acquisition is a challenge across the industry. And the big thing is how do you go and engage with the right type of member
Hmm.
through the right channel with the right product or the right offering. And that's a challenge for a lot of credit unions because number one, you don't have an infinite budget to go and do that. And so you can't just say, I'm going to just spray my entire, geographic footprint to see what sticks. It's just not really feasible. So how do you go segment that audience in a way like Molly walked you through where maybe sending stuff to 50,000 people isn't practical, but you know what? If you could break it down and say, what's the lowest hanging fruit in the demographic that's most important to us and the product that we'd like to push, if it's, hey, we want to drive more members and we want to grow deposits, maybe it's a checking account or something like that. How do we go find that 2,800 or 3,000 like Molly broke it down to, which is much more feasible for credit unions to go do and run campaigns behind as opposed to spraying to 50,000 people and hoping to see what sticks. And then the question becomes, what channel do you go engage these people with?
Exactly. That's a really good point. Who's most likely to respond to which channel? I think that makes a ton of sense. We have a question here from Fred. Can you elaborate more on the propensity model? How is the model developed?
Yeah. Molly, I don't know if you want to take that.
Or I'm here.
Oh, Allison will take it. Fantastic.
Hey, sorry. I'm here. I'm here as substitute Tomer. I'm here out of my basement to answer these questions, to talk about how we build our propensity models. So let's talk like really simply. We don't use LLMs, which means that we can our models don't hallucinate. They don't make things up. They're not going to offer a discount to customers that don't exist. We also build all of our modeling systems based off of European style GDPR. So we don't use PII. We protect private data for customers, and we make sure that every single model is personalized for you. And basically, every single thing that we built has an objective in mind. Just setting something loose on your data, that's a no-go for a lot of the organizations that we work with. And so making things objective oriented means we kind of limit the scope that we're looking at, but we also break things down to the essentials. And so what we'll do is work with your data as it is in your system. Believe me, our motto has always been we've seen worse. No matter what, if you're in a data transition, you're in the middle of a merger. It doesn't matter to us. We will help you find value wherever you are. And basically, what we're doing is trying to find the customers that match that objective the best, and then find the drivers behind that objective. And so we're able to sort of use more spatially oriented AI. This is the AI systems developed out of Carnegie Mellon University, which is where Tomer and I both graduated from. And it means that we end up with really compliant models that are not going to surprise you, and they're going to be designed to work exactly where your customers are to drive the most value. Hopefully that makes sense.
Excellent. Thank you, Allison. We have a follow-up question as well. Does the propensity model take into account rate-driven variables to target refined segments? Great question.
Yes, it's definitely one of the things we can make sure to add to specific models. There's some that are driven just based on a market basket of products. It depends on what your exact needs are. The fun part of developing models is that we can work with our customers to find the thing that suits them the best.
Excellent. And how quickly, Allison and Dave, and maybe Molly as well, do you think that a credit union can really operationalize the propensity model once the data is fully connected?
Yeah, Molly's the one who's lived this.
Yeah, so we've seen credit unions who have been able to activate in the platform within as little as 15 days from sending us their core data. Once they've sent us their full data set, so depending on how quickly your IT team can send us all of your data, then we can get you your models to be able to activate. Within, a month of that. It all depends on your team's readiness because the data is just one piece in the larger puzzle there. So, taking into account all of the other moving pieces, do you have your campaign collateral? Do you know what the call to action actually is? All of that. Those are all moving pieces once you know who you're going to talk to. So, that is definitely, we can give you the who, you just need to know what the what is. But yeah.
I mean, we've all been through integrations that take months or years. Our goal is to not be
Exactly.
that kind of vendor.
Yeah.
And so for a credit union, because I know that I've heard this before, for a credit union that has kind of jumbled data, maybe they weren't always the best at keeping the data, and that not as a fault of them. What would you say? Are we still able to build these models for them? How long does it usually take for thinner data or even newer credit unions?
Yeah, I mean, the fun part of what we're doing is okay, so we're old fashioned and we kind of do things a little differently than everybody else, which means that you can still talk to a person here. And so generally when you help you on board, there's going to be a human who will be helping you do that. We're not just going to throw you to the mercy of the robots. And because we have those humans, we can help you like figure out exactly what you need based on your timeline. And sometimes that might mean, hey, we've got a lot of internal third-party data. We can get you started almost right away with that, so that you have time to get your ducks in a row, but you might have to get a campaign out immediately. We can also work just to get like the essentials in so that you can start to have exactly what you need. The best thing we can do is, we've worked with tons of banks before. We know exactly what kind of data can drive decisions. We'll work with you and your team basically to pull out the essentials so you're not having to go everywhere or look at everything. It can be really overwhelming. We work with our customers to target and pull exactly what you need to make the decisions that you need to make on a time frame that suits your business.
Thank you. That's excellent. And what are some of the most common things that credit unions use the models for? So is it maybe looking for folks that are looking to refinance or have the intent to do that? What are the most common use cases that you see within the propensity models?
Oh, Molly's smiling up there. I feel like
Yeah.
she's closer to this than the rest of us. Go ahead, Molly.
Yeah, I've seen use cases across the board. Um, I would say checking accounts. I mean, everyone wanted cheap deposits up through last year. I mean, they still want that, but definitely just kind of growing that share of wallet is what we're hearing more and more. Increasing products per member is now the term that I hear across the board now. But as a whole, and I'm seeing this question kind of being answered, so I'll address this or ask now, so I'll kind of address this too. The most successful campaigns we've kind of achieved and seen working through our partnerships is those who are really working both. I mean, working with existing members is a huge one, but also we're seeing a lot with member acquisition campaigns. That's become a huge focus with our customers now. Through those kind of multi-channel campaigns that our customers are running, that's where you see a lot of success because reaching out to people who aren't your members yet through member acquisition is a challenge. People who don't know who you are, so sending them just a direct message via email or mail, you need that kind of multi-channel activation there, but it can be a really kind of fruitful campaign there when you're reaching out directly to them and have those additional channels where they're seeing and hearing from you all the time too. So I've seen some really encouraging open rates, response rates. I don't have the numbers off the top of my head, but I've been really excited to see those. So it's a variety of options, but definitely I would say growing share of wallet and member acquisition are the top two there. Yeah.
Yeah. Excellent. And so I know that this is something we've been getting asked a ton. Will these numbers be refreshed when the Q1 2026 data comes out? How often should credit unions be looking out for this data? Could someone maybe speak to that as well?
Yeah, they will be refreshed quarterly. There is a little lag depending on how quickly all of the credit unions get their data updated. What we saw is I think it took about 5 weeks for us to get the full roll up from the year end just because the numbers came in staggered a bit. And so in order for us to do the appropriate analysis based on how you're performing within your various tier or within your state, we kind of need to have all of the data, not just your data. And so little lag, but yes, they will be updated quarterly.
Excellent. Thank you. We only have time for one last question here. This is a question in the chat. How can BlastPoint help me with improving AMR?
Well, so average member relationship, I think, Molly, I don't know if you want to touch on that. That comes back to kind of next best product and things along those lines and lifetime value.
Yeah, exactly. So, increasing your member engagement as a whole, I always say at the root of any sort of member attrition problem is engagement. So, increasing the number, and I bring that up because we also address, churn, we address so many other issues, and we're talking about that being kind of a pressing issue right now for credit unions. Member engagement is something that all credit unions, in my opinion, can really improve on and nurture because there's so much opportunity there. there. There's so much room for growth, and that's really something that can be viewed pretty positively through member onboarding campaigns and being really data focused there. But also, really, those propensity models, it's really pretty easy to see really strong results using those propensity models. And I would say leading with your business use case, focusing on what also you need on the books. Do you need more loans? Do you need more deposits? That will help you both with your average member relationship, and also with what will financially benefit the credit union there, because you will always have members who don't have a product that will be financially beneficial to the credit union to get more of. So it will help you with those insights, and you will have, um, you know, a propensity model available to you to help grow that relationship there. Yeah.
Excellent. Well, I think those were all the questions. Dave, if you want to take us home.
Yeah, I mean, just to close it out, I believe all the attendees, we will send an email with the link to the CU scorecard. You also had the QR code there to access it. If you have any challenges with finding your information or just accessing the scorecard in general, don't hesitate to reach out. We'll make sure that we get you what you need. And we appreciate everybody taking 45 minutes of their day to spend with us. See you, everybody.